Hello, my CFA friends. Are you ready for round two, my friends? Hope you're starting to enjoy economics. It's a really nice topic if you want to get some low-hanging fruit. So, shall we get started? All right, so here's my stick man waving at you again. And yes, we are going to be looking at economics again. In particular, we are looking at understanding the business cycles. Okay, exam focus. All right, so we're going to look at overview of the business cycles. So we're going to tell you basically different definitions of how we could look at the business cycle. We're going to look at something called the credit cycle, and we're going to also touch upon various economic indicators. So we're going to look at leading, lagging, and coincident indicators. So I think it's not going to be particularly long video. Nice and punchy and short, and hopefully it's going to give us some good points. Okay, so business cycle overview. You can see here, business cycle is looking at things like expansions. All right, let's underline this stuff. Expansions of the economy, contractions of the economy. And there are basically three definitions they want me to understand. One is the classical cycle, the other one's the growth cycle, and the third one is the growth rate cycle. Okay, so it's pretty definitional here. I'm not gonna lie to you. So there's no logic that you're gonna be applying here. There's no analysis. You're just gonna plow through these definitions and you're gonna move on with your studies. So your classical cycle is basically looking at oscillations in GDP measured in volume. Okay, the growth cycle is going to be looking at these oscillations relative to some sort of trend. So you're going to have kind of the long-term GDP trend. Of course, here we also often mention a key word, the word potential GDP, my friends, which actually is taken to mean full employment. I like to think of this as the capacity of the economy. Okay, so what's my full employment GDP? What's my potential GDP? And so then I can look at how the actual GDP relates or is relative to the potential GDP. Sometimes it can be above it, which means that we're kind of expanding, we're bouncing. And then sometimes it's going to be below it, so we're going to have a recessionary gap, and so on and so forth. And then the third definition is the growth rate cycle, which is basically where we're going to look at the growth in economic activity. So the name of the game here is the growth rate, right? We're measuring the growth rate now. We're not measuring the GDP in dollar terms. Okay, so nice little picture here. On the vertical axis, we've got our real GDP. Now, of course, you by this, your studies probably know the difference between real and nominal. Real is measured in goods and services, right? How many apples and pears and cars and buildings we can output in a year, right? That's your real GDP. And then on the horizontal is time. So it's some sort of time series here over time. We could see the nice steady, the steadily sloping red line, which is your trend GDP. And then we could see also the oscillations, as I said. Sometimes we can be above in an expansion, and sometimes we can be below that trend line in a recession. So we need to memorize that there are 4 phases of the business cycle. So they're going to be recovery, expansion, slowdown, and contraction. And we can kind of see them here on our diagram. So first we're going to start with the extremities. The extremities are the peak of the cycle, so that's the top of the cycle, and the trough, which is the bottom of the cycle. So obviously, once we've sailed through the bottom, through the trough, and growth turns positive, but we are still below full employment, that's known as the recovery. Okay, so after we sail through the midpoint here, and we're still growing, but we're now in positive territory above the potential GDP level. Now we are in an expansion, right? Then we're going to reach our peak. Then we're going to start turning, right? That's the pivotal point. We're going to start turning. That's known as the slowdown, but we're still above full employment. And then once we slip under the potential GDP, that's now known as a contraction. And that's going to lead us to the trough of the economy. Okay, so another concept that you've got here is the concept of credit cycles. Very, very important concept, right? So credit cycles refers to the availability and price of credit. And what does that mean? So credit, what does that mean? Availability of credit. Basically availability of money. Okay, is there money in the economy? And also, what is the price of money? So, for example, interest rates, right? So when you've got high interest rates, you are paying high interest on your loans and mortgages. Okay, so when credit expands, right, there's a lot of money in the economy. When credit contracts, there's less money in the economy. Okay, so that hopefully is going to be pretty intuitive. So the second bullet, strong economy leads to credit expansion. Okay, so strong economy, we're in an expansion, we're booming, we're bouncing around, we're very confident, we're exuberant, animal spirits, all the good stuff. What are the lenders gonna do, my friends? They're gonna lend, right? When everyone is doing well, the lender's gonna lend. There's gonna be credit expansion. This additional money in the economy will fuel potentially asset bubbles. So think about interest rates being very, very low. Think about lenders being very confident that asset prices are going to keep going up. I hope that sounds familiar. Spoiler alert, GFC, right? So I hope this sounds familiar. If interest rates were very low, if lenders were very confident, if mortgage brokers were very confident, if rating agencies were very confident, if borrowers were very confident, if we were relaxing our lending standards, lending to ninjas, no income, no job, no assets type of borrowers, well, of course, that's gonna lead to asset bubbles. So if you come from the Austrian School of Economics, you're gonna talk a lot about credit expansion, credit contraction being a big driver, right? So when we have credit expansion, that's going to fuel the economy up. When we've got credit contractions, of course, that's going to do the opposite. So extreme peaks here in credit cycles may be followed then by systemic banking crisis. And that's exactly what we saw, my friends, in the period 2007 onwards, right? And we saw a fair amount of bailouts and restructurings and consolidations in the banking system. Now you've got also weak economy. Okay, so I've got a weak economy that's going to lead to credit contraction. Now the opposite is happening. Lenders are getting nervous, people are losing their jobs, cash flows are weakened. So lenders are going to lend less. So that's kind of going back to this idea of pro-cyclicality of lending. So in good times, lenders lend a lot, and that fuels the bubbles. In bad times, they contract lending, and that also exacerbates the recession, the contraction. So weak economy is associated with credit contraction, and of course, that's going to lead us to having lower asset prices. And of course, your investors can use our stage, so where we located in the credit cycle, to understand how severe the recession may be. Right. So then you've got this economic indicator business here. And what this is about, this is going to provide you information on where we are in terms of the state of the economy. Okay, so you've got three flavors here. You've got leading indicators, you've got coincident indicators, and you got lagging indicators. And I've given you some examples of each. That is not an exhaustive example. These are some examples of each. Now, I don't believe that you have to memorize every single one of them, but basically have a look, get some working knowledge, and then hit some questions. See how you're doing on actual questions. So your leading indicators are indicators that are going to tell me something about the economy ahead of the event, right? Ahead of the turning point. And here a good example I would say is the stock market, because the stock market is a forward-looking indicator, right? That's why we call it leading indicator. It's forward-looking. Stock market is always forward-looking. So for example, stock market will rally ahead of the expansion and will sell off ahead of the recession, because already the market is thinking 6, maybe 12, maybe 18 months ahead. That's why we call it a leading indicator. All right, my friends? Now, coincident indicator is an indicator that coincides with the turning point in the economy. Okay, that's a coincident indicator. And then you got a lagging indicator that is basically a very, very slow indicator, and it lags the economy. So it happens after the fact. So it's maybe a little bit less useful, because obviously you can't use it as a predictor, but you can use it as a confirmation that recession has indeed happened or expansion has indeed happened. All right. And then you've got a diffusion index. All right. A diffusion index basically creates a composite. All right. It creates a composite of leading, coincident, and lagging indicators. And then what it does is it measures the proportion of items in that composite index that are moving in the same direction. So essentially, a diffusion index is going to be measuring the breadth or the strength of a particular economic movement. Okay, so as I said, it's not until you hit some questions that you're going to gain confidence that you're actually doing well in a topic. All right, so let's have a look at a question. And of course, you know what you got to do. I'm not going to keep saying this. Pause the video and try to do the question in your own time. Okay, so inventories tend to rise when Alpha Bravo Charlie, inventory sales ratios are low, inventory sales ratios are high. Now this just does sound quite opposite, so I'm already thinking it's gotta be one of those, maybe. Or Charlie, economic activity begins to rebound. Okay, so the key word here for now is rise. Okay, so we want to find the answer where inventories are gonna be rising. So if I think about this ratio, then it's gonna be inventory over sales. Okay, so Alpha says inventory sales ratios are low. So I've got low inventories relative to sales. Okay, so the ratio is low. So that probably means I've run my inventories down. I have very little inventory in stock. Well, if I'm a sensible business person, I probably will need to purchase new inventory, or else I will run the risk of a stock out. So that sounds like it's gonna be our answer, but let's go over the other two just to rule them out. So inventory sales ratios are high. Well, that's the opposite. That means now you've got tons of inventory in stock. Perhaps you're in a recession, nobody's buying your inventory, you overbought, and now you're swimming in inventory, my friends. And obviously your inventory sales ratio is high. Now, would you want inventories to rise further at that point? Well, no, because you're going to probably slow the rate at which you purchase new inventory, and you're gonna wait until you sell some of the existing inventory. So that's not gonna be right. Charla, economic activity begins to rebound. Okay, so when economic activity begins to rebound, what's gonna happen is your sales are going to pick up, and the rate of sales will probably outweigh the rate of purchase of new inventory. So inventories are likely to start dropping, sales are likely to start rising. So that should lead to a drop in the inventory sales ratio. So therefore, that's also not going to be our answer, and therefore we are going to be selecting alpha. Okay, there's another question here on a diffusion index. So a diffusion index is alpha. A diffusion index measures growth, or BRAVA reflects the consensus change in economic indicators, or CHALA is roughly analogous to the indices used to measure industrial production. Okay, now that kind of question, it could puzzle me if I haven't recently looked at what a diffusion index is, right? So it's not my favorite question. I do like my analytical questions or my little formulae questions better than this type of thing. But, you know, we inevitably are going to get some definitional questions, and we just need to know what these things mean. So luckily for us, we have this in our slide. So let's just read it one more time. So diffusion index combines indicators. So in our case, it combines leading, coincident, and lagging indicators together to create a composite index. And it measures the extent to which those indicators move in here's the keyword, same direction. So can you spot one that kind of sounds like that? And if you are thinking BRAVA, I'm looking at the word consensus. So it's some sort of index that forms a consensus in terms of the direction of the economic variables, right? So the other two answers do appear to be made up. So I'm going to be circling BRAVA here and moving on with the rest of my exam. And obviously, I will be hoping that I got this question right. Well, my friends, thanks for watching and have a great day.